Bonjour, Team 42. It's your skipper here. No, how you doing? Good morning, everyone. This is Darius Dale here, checking in from France from Tuesday, May 24th, 2022, presenting our macro minute. Starting with asset markets, we have stocks down this morning, commodities mixed with industrial metals lagging, crypto down, dollar flat, global bond yields down, big reversal from where they were this morning. Market moving headlines. What's another $100 billion amongst friends? You got a big drop in tech shares after Snap cut its guidance pretty significantly, actually, and blamed supply chain disruptions. I can kind of see that on the in terms of retailers not having goods to sell and pulling advertising spend. But come on, Snap, down 29% pre-market, obviously dragging down peers with it. Definitely go check on our May 22 macro scouting report slides, 73 to 88 in particular, where we walk through our Dow outlook for growth, particularly from a extreme leading indicator perspective. And ultimately, we think the profit cycle is rolling over here, and that will provide a support for another leg lower in equity shares. Next bullet, why ask 42 macro when you can ask Goldman Sachs 6 to 9 months later? So the fine folks at Goldman, our friends at Goldman, we have a lot of friends who work there. They signaled that they said the market sell-off will bottom when the Fed signals the end of tightening. Unfortunately, that's a hard and which may not happen until recession is apparent. That's also a hard duh. I thought this was interesting analysis from Vicky Chang, who does great work over there. She said monetary policy has historically stopped tightening about 3 months before equities bottom and shifted to easing about 2 months afterwards. So in terms of hearing that dovish, those ambulance sirens that we're all waiting for, we're going to need to see a lot bigger slowdown in growth and a much more significant deceleration in inflation than we've observed thus far. Per Powell's comments last week, clear and convincing. And I learned from one of our clients or subscribers, who's a lawyer, emailed me on this weekend and said, hey, clear and convincing is a pretty high legal standard. And so that likely means that, 1 month or 2 months of slowing CPI that's still, obviously comfortably above trend and comfortably above their target is not going to cut it for those of you who are looking to bottom fish in markets. And just really quickly as a side, I know this is going to turn into a macro 10 minutes, but the vast majority of people I just have conversations with to this point are still trying to figure out, when do they buy the dip? When do they buy? When do they buy? Bear markets don't end with a bunch of people asking questions about when do they buy. They end when everyone is hopeless and concerned about the end of the world. And we are definitely not at that point of despair yet. Shifting gears to next bullet. Nothing like an ill-timed ECB hike to cement a global downturn. So friendly Christine Lagarde finally broke rank, or didn't break rank, but really confirmed, did something that most central bankers are unlikely to do, when she effectively said, they're very much on they've reached a turning point, effectively, to use our own phrase, in terms of their willingness to start hiking aggressively. And so this is you go back to 2008, you go back to 2011, obviously 2008 global financial crisis, 2011. You had the European sovereign debt crisis. Our friend Jean-Claude Trichet, the former ECB head, hiked rates into the teeth of those downturns both times. So we do suspect that the ECB will be this Christine Lagarde-led ECB will be following in his famous footsteps there. And then I thought this comment was pretty interesting, going back to our bear market discussion. Rich people are still sitting pretty after 3 years of aggressive gains. This is 2019, 2020, and 2021, three of the best in terms of a 3-year stint for the equity market. Is three of the best years in U.S. equity market history. And the U.S. UBS CEO, which obviously they're sitting on a trillion, several $1 trillion of rich people's money, said their wealthy clients are definitely interested in staying invested in markets, so not necessarily pulling money out. They're not necessarily putting new money in, but certainly we do believe that when they get panicked enough to start pulling money out, we'll be a lot closer to a bottom than we believe we are today. For those of you who are new, go check out our March 12th Around the Horn. We use 3 different sort of analytical frameworks that all arrived at somewhere between 3,200 and 3,400 as a target for a durable bottom on the S&P 500. Obviously, we're a lot higher than that still today. So that's why I sound so bearish. But one thing we're not so bearish on is China. We're getting more signs of fiscal stimulus there. Another 21 billion in additional tax rebates taken up. Their tax rebates this year to a couple $100 billion. So that's on the margin positive. We'll really start to see that filter through to positive growth impulse as we kind of come out of lockdown, which we very clearly are not yet, as evidenced by the Shanghai Composite dropping 2% day over day. Now it's only down 0.5% month over month. It's a little bit different month over month decline versus something like the NASDAQ, which is down 2%, down 11% month over month. Bloomberg Industrial Metals Index minus 2% today to down 13% month over month. Shifting gears to our volatility adjusted momentum signal and probable range processes. US dollar, that's still bullish VAMs there. It's still at the lower boundary of its probable range with 3.4% upside. It's starting to knife through there now. So let's keep our eye out here. We might have seen a peak in the dollar here. We got to give it some time and let it breathe here. But this is certainly something we've done a lot of work on with respect to the U.S. The change and the evolving dynamics with respect to the U.S.'s capital cow dynamics. And I think that analysis will certainly sort of be rewarded with a pretty significant dollar decline. It doesn't have to start today, but if you do eventually anticipate that once we get to the real selling where those UBS clients are actually pulling money out of markets, that's when you start to see those capital outflows reverse in a way that may perpetuate dollar down and stocks down at the same time, which would be a little bit something different than what we've been used to in the last few months. Gold's bearish FAMs. It's getting towards the upper bound of its probable range, minus 5.1% of downside versus 0.9% of upside. 10-year nominal treasury yield bullish FAM still hugging the lower boundary of its probable range with only 1 basis point of downside, 48 basis points of upside. Still kind of just, we're still channel checking to see if bonds have peaked in yield terms and bottom in price terms. Can't confirm that yet, but certainly this hugging of the lower boundary is telling for now. High yield OES bullish FAMs minus 41 basis points of downside, 46 basis points of upside. Still nowhere where you would expect to see them get to if we are in fact heading to a global downturn. S&P 500 bearish FAMs still minus 7% of downside, 5.2% of upside. VIX still neutral VAMs. Now, vol continues to be very well supplied, just based on the great work of our friend Jim Carson over at Kai Volatility Advisors. I don't have to tell anybody on this program, check his work out. Most of you certainly follow Jim. Minus 24% of downside versus 28% of upside. NASDAQ 100 bearish VAMs, minus 8.7% of downside versus 8.1% of upside. Still looks like a dog. Will continue to look like a dog, in our opinion. Russell 2000 bearish VAMs, minus 10% of downside versus 4.9% of upside. Bitcoin bearish VAMs, minus 20% of downside versus 8% of upside. Ethereum bearish VAMs still minus 25% of downside versus 12% of upside. We had a Vitalik Buterin, if I'm mispronouncing the name, please don't shoot me, came out and effectively confirmed that we will see the Ethereum 2.0 split in August. But guess what? It's late May, and that's a long time from now in terms of volatility, in terms of the realized vol we've seen in the crypto market of late. So just be aware of that. If you're buying on the August Ethereum 2.0 split, just be aware that it's not August. Shanghai Composite bearish FAM still. Looked like it was, trying to huddle its upper bound of its probable range to break out to at least neutral VAMs. Finally getting rejected this morning. We'll see if that rejection holds or if it's we get back on the train. The little engine gets back on the train. Minus 4.8% of downside versus 1.7% of upside. WTI crude oil broke the bullish FAMs yesterday. Finally getting a downshift in the OVX to a less onerous state from that signals perspective. Minus 6% of downside with 14% of upside. Agricultural neutral VAMs. Minus 4.7% of downside versus 1.9% of upside. And then industrial metals, they're still bearish. VAMs, minus 6.9% of downside versus 2.2% of upside. So with that, Darius Dale presenting our macro minute for Tuesday, May 24th, 2022. Best of luck out there today. Cheers.